Just a couple decades ago, it was very difficult for investors to access alternative investments like private equity, venture capital, infrastructure, or even commercial real estate. These investments used to be mostly reserved to the wealthiest and best connected people, and the rest of us were then limited mostly to stocks and bonds. But times have changed, and it's today easier than ever before to invest in these alternative investments. Many of them are publicly listed, they're crowdfunding platforms, and also far more service providers today to help you invest in these assets in the private market. As a result, portfolio allocations have already started to shift in favor of alternative investments, and according to a recent study by Brookfield, institutions today invest about 30% of their portfolios into alternative investments. That's up from about just 5% 20 years ago, and they expect this to grow to about 60% by the end of this decade. And in that sense, my portfolio is quite futuristic because it's already very heavily tilted towards alternative investments, and this is intentional because I expect it to result in higher total returns with lower risk, higher current income, better inflation protection, and also superior diversification benefits. Hey everyone, this is Jussi. I run a small investment firm that specializes in REITs and other alternatives, and in today's video I'm going to talk to you about my 3 biggest alternative investments. But before I get into it, I want to let you know that we just started a 4th of July sale for REIT newsletter. So if you want to access my entire portfolio, now is a great time to join us. We're also offering a 2-week free trial, so you have nothing to lose to give it a try. So the first alternative investment I'm going to discuss here is that of private equity. Many of you are likely very heavily invested in the publicly listed equity market, so regular stocks. However, you probably don't hold much or any exposure to private equity, and this is quite unfortunate because private equity has historically often been a lot more rewarding than public equity, and so you're essentially giving up liquidity to earn better returns, which is well worth it to long-term oriented investors. But even then, a lot of you don't invest at all in private equity simply because you may think that's inaccessible to you. But that's not necessarily true. Today, a lot of these big private equity companies like Blackstone, Brookfield, KKR, Carlyle, Blue Owl, there are many others, are publicly listed, and so you can essentially participate in the returns of their private equity funds by buying the stock of these companies, and these companies directly benefit from the returns of their own funds by earning management fees, incentive fees, and often also holding co-investments in the funds themselves. Many of these companies have done exceptionally well over the long run. The biggest of them is Blackstone. I'll put a chart on the screen that will compare the returns of Blackstone versus the S&P 500 over the long run, and you'll see that the S&P 500 was very rewarding, but Blackstone earned more than 2 times higher returns. In that sense, these publicly listed private equity companies really offer you the best of both worlds. On one hand, you enjoy the liquidity of the public markets, and on the other hand, you enjoy the superior returns of private equity companies. But what is my favorite investment opportunity in this space today? I don't think that it is Blackstone. I think that it's getting a bit too big for its own good. It's managing over 1 trillion of assets under management. This is likely going to slow down its future growth and also reduce its future returns. Rather, I prefer to invest in smaller and emerging private equity companies that are experiencing rapid growth and are heavily discounted. My favorite opportunity today is a company called Patria Investment. Its ticker symbol is PAX. This is also known as the Blackstone of Latin America. It today only has about 50 billion of assets under management. It's growing at a really rapid pace. It's offering a high dividend yield, and I think that's ultimately worth about 2 times more than its current share price. Our analyst Samuel Smith actually just recently talked to their management team and filmed a video discussing the company on his own YouTube channel. I highly recommend that you go check it out, and I'll put a link to it in the description of this video. This is my biggest private equity investment today, and I keep accumulating more of it at the moment. Then after private equity investments, I want to talk land investments, which also make up a significant portion of my portfolio. But before that, if you think that this content is valuable, could you please do me a huge favor and click the like button and subscribe to the channel? It helps me a lot to keep on growing. Thank you so much in advance. Mark Twain famously said that buy land, they're not making any more of it, and he understood really well that well-located pieces of land are limited in supply simply because we're not making any more land, but they are ever growing in demand, and therefore, because of the simple laws of supply and demand, their value should keep on growing steadily over time. But land investments can take different forms. It can, as an example, be land on the path of growth. Back when I worked in private equity in 2016, we're buying land in a small city in Texas called Princeton, as an example. It's a city that's north from Dallas, and we thought that the city would keep on growing towards the north and that eventually this piece of land would become valuable to developers, and we could also force value creation by working with the city to change the zoning of the land, get some permits for it, and we were correct. eventually we were able to sell a piece of this land to a developer, and just by selling a piece of it, we were able to recoup all of our money and then some. So it was a very successful investment. Another form of land investment could be farmland, and this is perhaps my favorite type of land investments. It might be my favorite type of land investment because unlike most other land investments, farmland is actually generating rental income. You typically lease the land to a farmer that's paying you rent every year while you wait patiently for long-term appreciation. And if you look at the track record of farmland as an investment, historically it has outperformed most other asset classes, including bonds, stocks, gold, and even REITs. I'll put a chart on the screen where you'll see the historic performance of farmland, and keep in mind that these returns are unleveraged. So if you added a mortgage on the property, your returns would have been quite a bit stronger. You could have earned closer to 12 to 15% annually, which is in my opinion very attractive coming from such a defensive, recession-resistant investment. I mean, food is our most basic necessity. We cannot live without it. Whether the economy is booming or in a recession, we keep on eating, and so it's a very defensive asset class. It's not volatile. As you see also in that screen, it hasn't crashed in value as these other investments have during recessions, and yet it's still producing these very strong returns. This likely explains why Warren Buffett, Bill Gates, Michael Burry from The Big Short, and many other legendary investors have historically talked very positively about farmland investments. But unfortunately, it has historically been quite difficult to gain exposure to farmland, but this has started to change. There are now a few publicly listed REITs. I have previously said that I've invested in one REIT called Farmland Partners, which in my opinion is undervalued today, but there are also some crowdfunding platforms, and I have previously invested in one called Farm Together. I've also discussed it previously on this channel. I'll put a link in the description if you want to learn more. I think that they actually have one deal on their website at the moment. It's almost full. It's, I think, over 90% full, but there's still a bit of capacity. And what I like about Farm Together is that they're offering high yielding farmland deals for the most part by focusing on higher yielding crops and typically targeting land that has perhaps some issues that they can work on to force value creation. And so I get my exposure by combining REITs and crowdfunding in this specific space. And then finally, my biggest alternative investment is that of real assets. This is really what we cover most of the time on this channel. There are investments like cell towers, e-commerce warehouses, manufactured housing, fiber networks, data centers, and so on. This is essential infrastructure. It generates significant rental income. It has historically also provided good inflation protection, very competitive returns compared to bonds, stocks, and other asset classes. And I get most of my exposure through publicly listed REITs as well as some private investments. But lately, most of my capital has been going towards publicly listed REITs because they are heavily discounted relative to the private market value of the assets. To give you an example here that I like to use, BSR REIT owns Texan apartment communities. It's a REIT that's conservatively financed. They have very good management that's well aligned with shareholders. They enjoy economies of scale. They are well diversified. There's no issue. This is a high quality REIT, and yet it's today priced at a nearly 40% discount relative to the latest net asset value. So essentially you here have the opportunity to buy an interest in this portfolio of Texan apartment communities at about 60 cents on the dollar relative to the fair equity value of the portfolio. And then you get the additional advantages of diversification, liquidity, economies of scale, professional management, and so on top of that. I think that this is a historic opportunity because normally it should be the opposite. The private market asset should be priced at a discount relative to the REITs and not the other way around, because the REITs, again, they are liquid, they're professionally managed, you enjoy limited liability, economies of scale, and many advantages that deserve a premium relative to the value of the private assets. Historically, REITs have traded at a premium during most times and eventually expect their valuations to recover and richly reward investors. In a recent video, I explained that I think that this could happen already in the near term because there are some powerful catalysts at play here. I think that one is the expected cut to interest rates, and the second one will be the acceleration in rent growth in 2025 and 2026. I think that this combined together should be a strong catalyst that could lead to an epic recovery already in the near term. If you want to learn more about the REIT opportunity, I'll also link a video in the description of this video. So to recap here, most investors are today allocating the bulk of their portfolio towards stocks and bonds, but I'm different in that I'm allocating most of my portfolio towards alternative investments like private equity, venture capital, land, infrastructure, commercial real estate, and I get this done mostly with publicly listed companies like publicly listed private equity firms, some crowdfunding platforms, publicly listed REITs, and I do so because I expect this to lead to stronger risk-adjusted returns over time. Now, if you want to access my entire real money REIT portfolio, you can do so by joining High Yield Landlord, which is my REIT newsletter for a 2-week free trial. This is a real free trial in that you won't be charged anything in the first 14 days. So if you want to join just to see my portfolio and then cancel, that is perfectly fine with me. There's also a $100 discount for the 4th of July in case you decide to stick with us for the long run. I'll put a link to it in the description of this video. And then finally, once more, if you could please click the like button and subscribe to the channel, that will help me a lot to keep on growing. Thank you so much in advance. See you at my next one. Bye-bye.